When you sell a residential property and make a profit, it can trigger a capital gains tax (CGT) liability. However, there's good news. The UK offers a valuable tax relief known as Private Residence Relief (PRR) that can exempt some or all of the gain from CGT. Let's explore how this relief works. Qualifying for PRR. To be eligible for PRR, you must be selling a dwelling house that has been your only or main residence. While the legislation doesn't precisely define a dwelling house, various case laws offer guidance. In most cases, your entire living space qualifies. This can include not just your main building, but also related structures like garages or outbuildings. Flats or self-contained units within a larger building can also qualify. Occupation and quality. To qualify for PRR, your property should have been occupied as a residence. This implies a degree of permanence, continuity, and the expectation of continuity. HMRC doesn't specify a minimum duration, as it assesses each case individually. Quality of residence matters more than the exact time spent. Activities like cooking, eating, and leisure time spent at the house demonstrate quality of residence. Business use. If any part of your house is used exclusively for business purposes, the related proportion of the gain won't qualify for relief. It's important to keep the residential nature of your property intact. Marriage and PRR. Married couples and civil partners are allowed one main residence between them. After marriage, if both partners own separate residences and continue to use them as residences, they can jointly nominate one as their main residence for PRR. This change can expose the other property to CGT. Separation and PRR. In the event of separation, the transferor spouse can claim continuing PRR for the period from ceasing to occupy the property up to the transfer date if the property remains the transferee spouse's main residence. This is subject to no election for another main residence during that period. For disposals from April 6, 2023, the same rule applies even if the property is sold to a third party. Tax calculation. The gain eligible for relief is calculated by multiplying the total gain by the periods of occupation and dividing it by the total period of ownership. Certain periods of absence can be treated as actual occupation, preserving relief. Qualifying periods of absence. Various periods of absence qualify as periods of actual occupation, including absences not exceeding 3 years, absences due to employment outside the UK, and certain employment-related absences. Final period exemption. The final 9 months of ownership, regardless of property use, qualify for relief. This period extends to 36 months under specific conditions, such as residing in a care home. Lettings relief. Lettings relief can exempt up to £40,000 of gain per owner when a former main residence is rented out, provided there is shared occupancy. However, as of April 6, 2020, properties not in shared occupancy no longer qualify for lettings relief. Let's illustrate this with an example. Harry acquired a house on the 1st of April 2009 and sold it 15 years later on the 31st of March 2024. Harry occupied it as his main residence for 10 years from the 1st of April 2009 to the 31st of March 2019. It was then let as residential accommodation for 5 years from the 1st of April 2019 to the 31st of March 2024. It was empty until it was sold at a gain of £1,200,000. Net gain is £1,200,000, less PRR, relief is £860,000, chargeable gain is £340,000. Instead of letting out the property, if it was occupied as main residence for at least 14 years and 3 months and sold with a gain of £1,200,000, there would be no chargeable gain after applying PRR. From April 6, 2015, PRR rules were amended for UK residents. A property can only be considered a main residence for a tax year if the owner or spouse is tax resident in the same country or stayed overnight at the property at least 90 days during that tax year. Filing and payment. When PRR is unavailable or partially available, a UK land disposal return must be filed within 60 days after the property's sale. Additionally, a payment on account of CGT may be required. Private residence relief can be a substantial tax-saving opportunity when selling your home. Understanding its nuances can help you make informed financial decisions. For more tax and finance insights, stay tuned. Thanks for watching.